Welcome back to Liquid Lunch, powered by CryptoQuant, the leader in on-chain data analytics and the source of some true alpha metrics. And so today, what a beautiful day, guys. We are joined by Matthew Seigel from VanEck and Julio Moreno, our head of research. How are we doing this morning, guys?
Pretty good day. Pretty good. Thank you.
Doing good. All right. And we just hit 60K. So we're super excited, and lots of exciting things happening in the Bitcoin space. We're going to jump into some weekly market research reports. But before that, if you guys do not have a CryptoQuant account yet, you guys want to look at some on-chain data, please go to CryptoQuant.com and sign up and get an account, and we can definitely help you guys get some of that alpha signal into what you guys are doing. And so I'll hand it over to Julio now, and we'll kind of go through some of our weekly market research reports.
Yeah, actually, this is a weekly report that we publish, and here we're explaining, as you said, like we got to 60K and explaining some of the drivers that we see that are making prices increase. So the first one, we always want to follow up prices in Coinbase versus prices in other exchanges to outside the US, to gauge like where's the demand coming from. And as you can see here in this chart, when the line turns green, right, it means like prices on Coinbase are higher than prices outside the US. And so we see that as a signal that there's more demand coming from the US, investors, traders. And this makes sense because of what we're seeing with ETFs, right? That all that is happening in the US. So we're seeing that driving the price increase lately. The demand from US based investors or in Coinbase. So that's one of the drivers. The other that we are paying attention to here is who's driving the price increase in terms of the market participants. In this case, we're seeing the holdings of large Bitcoin owners, the whales, right? The total holdings of those kind of market participants, and it has been trending up probably since last year. But now it has come to a level, the highest level since July 2022. So we're seeing this type of more large players accumulating Bitcoin. So that's the demand coming more from a large owner perspective. The whales are the ones that are more accumulating more. And also here, this is really interesting because it gives you a really, really good sense of where we are in the market cycle. This is the total investment, you could see it like that, of new investors, right, or new holders of Bitcoin, right? And so it moves in cycles. You can see like in the bull markets, as new money, new investors, or new people come into Bitcoin, their total, the total value of their investment increases as a proportion of the total holders, right? Because they are buying at higher prices. And
that was the last two tops there, right? That was the last two tops.
Yeah, exactly. So we're seeing like the last two cycles, 2017, 2018 here, 2021, 2022 here, right? And this is, from that perspective, we're only starting. We saw these
just begun.
exactly, and so this has increased from around, I think it's around 20% of total capital being in Bitcoin, invested in Bitcoin, now at 35%, but the tops come at above 80%. And so this is the this is how we can gauge like the new money entering, the new investors entering this market, and it's just starting. It's really, really interesting to see this how it moves in the cycles, right? And so yeah, that's the bottom line is demand from US investors, big investors, big holders, and also the growth in new money entering into the Bitcoin market. This is what we're seeing on chain, and of course after the price increase that we've seen in these last few weeks, I always want to some indicators of, okay, what can we expect? Can we expect a correction or not, or a pause? And so I like to look at these indicators, especially this one. Like this one is the we track the profit margins of traders, Bitcoin holders of between 1 month to 3 months, because they are more likely the traders, and their unrealized profit margins. That's what we track. And so we are always looking to, okay, when these profit margins or realized profit margins get a little too high, is when we can expect like a correction maybe, or a pause. And so we always want to track that. And of course, if we are getting to 60K, that unrealized profit margin has increased significantly. So it's something to pay attention to from that perspective.
Is that your secret alpha signal there, Julio? That chart, is that your dashboard for your secret alpha?
I mean, yeah, I really like this one. not only because I made it, but yeah, it gives you a really good information about,
you nailed the bottom of it too, I think earlier in the year. So
yeah, actually we used this one to be we were publishing, before the ETF approval, that we got to that approval at a high profit margin. And so we were expecting like lower prices after that. And then profit margin went to zero after that correction, right? And so typically in a bull market, when profit margins get to zero, this is when you can start seeing like a bottoming, a local bottom for prices, and that happened here a few weeks ago at $38,000.
And so anybody who wants to get access to these charts, if you go sign up at CryptoQuant.com, there's individuals that put together their own dashboards like this one you're seeing here. And so you can follow individual dashboards and others to find these different alpha signals.
Yeah, so that's something to take to be looking at right now after this price increase.
Awesome. Matt, any comments on any of this before we head into the interview?
Julio, I thought that was a great set of charts, and we're looking at a lot of similar series. Still observing some significant short covering. So the amount of short liquidations and the kind of short to long ratio on Binance, for example, it's not indicating completely one-way positioning. And also, like, the network is 90% plus in profit now, and once we reach that 90% level, we 100% tends to follow in pretty short order, just on a technical move. The other thing we've noticed is a bit of a divergence in the last few weeks between the on-chain activity and trading volumes. Obviously, a lot of that's ETF, but transaction fees are falling, new addresses are falling. So we'll see how that divergence resolves. But the history here and the cycles of Bitcoin tend to argue that most of the gains for the cycle comes post-halving or in the halving year. So it's really hard to get too bearish, despite what you highlight as some signs of kind of short-term overheating. You can see that in the funding rates as well. Shorts are being paid, north of 50% annualized on some of these altcoins. So that is quite heated, but that could be because there's just less leverage in the space, right? All the centralized lenders went bankrupt. There's just not huge balance sheets that are playing here yet. And so when you go on chain to get leverage, it's less liquid and folks are being forced to pay up.
Yeah, this is something that we also put here, like you say, the funding rates, they went really, really high, right? So that's another signal that could, it's too costly to go long, like I would say.
Yeah, pretty interesting as the ETFs are gobbling up the available Bitcoin. I think at like almost 10,000 Bitcoin per day. And so we've definitely got a supply shock coming in April. But you can go ahead and kill the screen there, Julio, if you want, and we can get into more of this. So guys, again, we're super honored to have Matthew Seigel from VanEck. He's the head of digital assets. And, we just wanted to kind of pick your brain on what's happening and everything. But first, I wanted to ask, I love your title as a recovering
Recovering.
CFA. So walk us through that, because I'm sure in your circle, like, you're probably the oddball. Like, they're like, wow, this Bitcoin guy is out there. We all get it, right? But especially in your circle, give us an idea of what that's like.
Yeah, I started my career as a journalist covering financial news at Bloomberg and CNBC. So I became familiar with the concept of fake news and narrative economics pretty early. And when I worked in journalism, the industry was in the process of being eviscerated by the Web2 platforms, which essentially hoovered up all of the information control and sold ads against our information. So I got envious of all my sources who had bigger balance sheets than me and found my way onto the buy side, worked for Cathie Wood for 4 years, got my CFA, spent a lot of time on fundamentals. And having worked for Cathie, and I was primed for kind of open source solutions to gain share from proprietary closed source, and so was relatively early to identify Bitcoin as a killer app among open source software platforms. And I noticed that the CFA Institute was, quite slow to embrace this asset class, and instead started adding bits to its curriculum about ESG and a lot of stuff that I think is kind of irrelevant, and missing the fact that social media has just dramatically changed the capital formation process. It's become much more mimetic, and crypto, because of the automation and the smart contracts, is the perfect manifestation of that. So disillusioned with the CFA curriculum. I also quit drinking 5 years ago, so that adds to the recovering as well.
Awesome. And so when did that happen then? When did the orange pill fully, like, go into Matthew's area of life? Like, when did that happen, and what was that journey like? Did you get into the altcoins? Maybe just give us like a quick overview of that journey for you.
Yeah, sure. I was working on the sell side, writing strategy for a Hong Kong-based broker, mostly equities, but kind of multi-asset. And this is 2016, and I read some books about like networks and how they operate, and wrote this research piece titled "Google is Evil," going through a lot of the winner-take-all dynamics of digital networks, and predicting that the centralized players would continue to grow. So it was like a bullish Google piece, but I time-stamped my first Bitcoin purchase in that research piece in 2016. So I kind of started with BTC, and as smart contracts developed, 2020 DeFi summer, got into that. And I'd known Jan VanEck, CEO of VanEck, for some time, who had his own similar journey, started around the same time, 2016, 17. VanEck as an institution being unable to bring the Bitcoin ETF to market because of these regulatory concerns, started investing privately across the space in venture. And that's how we built a network and got smart in the space. And then when I joined VanEck in 2021, we dramatically increased the range of products. So now we have 18 different crypto strategies. Most of them are kind of passive single token or multi-token baskets that trade in the US and in Europe. But we also have 2 actively managed private funds that are both liquid token funds run out of by a research team here in New York. And there we are able to express, ex-Bitcoin views, because we did kind of see the Bitcoin as distinct because of the regulatory certainty, and because of some of the characteristics of the blockchain. I think those lines are blurring a little bit. We can get into why that is, but that's our product offering is 2 private funds, a number of ETFs, an equity ETF, DAP that owns Coinbase and the Bitcoin miners, and then as you mentioned, we launched an NFT project today, actually, called Segment, that looks to make it easier for folks to fractionalize NFTs and retain some of the self-custody functionality. And we think we're going to find product market fit there as well.
Definitely want to get into that. Definitely want to get into that later. Okay, so now VanEck is doing some really cool stuff because you guys have some really cool marketing. You guys are the HODL ticker, right? Which everybody knows, right? Hold on for dear life, or however you want to interpret that meaning from that message on the Bitcoin boards back in the day. And so that's cool because you guys are just really, you guys are launching these new ads for, HODL life and all. So that's cool because you guys are really getting into the ethos. You guys are getting into the psyche of Bitcoiners, and even your Twitter account, I think it says, is ran by an intern, which is very cool. You guys are definitely tapping into that Bitcoin energy. Now, was that something that you had a kind of a play in? Did you kind of, or you just have like this marketing team that is kind of on signal there, or how does that work?
The CEO of the firm is orange pilled, right? So he is super bullish on these open source alternatives, and they require strong community, more direct communication with clients. And we're not tourists in the space, is I think the message that we're trying to get across. First TradFi institutional for a Bitcoin ETF. We are donating 5% of the profits from HODL back to Bitcoin core devs. We announced the same thing with our ETH futures ETF. So, we're friendly. We're trying to make friends, not be tourists, and it's those relationships that drive long-term business partnerships.
That's awesome.
I heard Matthew talking about a little bit of our regulations in the US. Can you just share general thoughts about the US crypto regulation status, and how do you see it, especially after the ETF approval for Bitcoin, more ETFs, or what are you guys seeing?
Yeah, I think the overarching answer is that the environment in the US is still very challenging from a regulatory perspective. That's because of, I'd say, two principal reasons. One is that the SEC objects to money managers holding coins on behalf of their clients. So when we set up these private funds, originally we onboarded with some self-custody solutions like Fireblocks, and then Biden took office, and the custody rule was proposed by the SEC, which required us to focus our custody with so-called qualified custodians. And there's very few of those, right? There's Anchorage, there's Gemini, there's Coinbase, but it really served to consolidate the custody business and make it harder to access some of the more experimental coins. And then the other challenge, well, three challenges. So that's the first. The second is that the SEC says that a number of these coins are securities. And so that adds to the difficulty in accessing them if exchanges are going to be less aggressive in listing them. I guess that's the two principal challenges around regulation. Yeah.
Awesome.
Do you
awesome.
just following on that? Also, about Bitcoin miners, right? Like the regulation, it seems like they want to, to maybe regulate some of the electricity consumption, or all that. Have you had any thoughts on Bitcoin miners specifically?
Yeah. I just remembered the third element of regulation is that the U.S. government doesn't want banks and brokers to touch these assets, right? And so as you see the distribution strategies by money managers and financial advisors, you'll notice that the banks and the bank-owned brokers have been slow or are not listing these ETFs as well. And so, we do expect that regulation to change over time, but it is a considerable headwind, and we constantly have to remind ourselves that this is not a U.S. asset class. This is the anti-dollar. The adoption has been much faster in emerging markets and frontier markets, and we manage active strategies in emerging market equities, emerging market debt. When Ethiopia last week announced that they are now mining Bitcoin via a government JV, and that made them the 5th country to announce that they're mining Bitcoin for, at the government level. We were ready for that. Our EM debt team has kicked the tires in a pretty detailed basis on Ethiopia's sovereign debt, and they are able to also participate in some kind of Bitcoin adjacent investments. So we get some good synergies between our various active investment teams, communicate pretty regularly on that topic. On the issue of Bitcoin miners, they've lagged pretty considerably here in the last month or so. So I think Bitcoin can hold above this kind of 50K level, which is the basically the break-even price post-halving for a number of these miners. That a well-capitalized Bitcoin miner should perform multiples of the spot price. And it's kind of related to that, to the Ethiopia story even. One of my fundamental calls for 3 years has been that there would be an ESG backlash and that the environmental concerns about Bitcoin would lose legitimacy. And from what we see covering natural resources, observing what's happened in Canada, in the UK, that call, the ESG backlash, is playing out through a combination of consumer revolt, people not wanting these EVs, industrial pragmatism, and then judicial intervention where the court stayed the Department of Energy's attempt to force Bitcoin miners to reveal details about their energy consumption. And then at the company level, the Bitcoin miners have deleveraged. They are taking share of hash rate. They typically outperform the spot price by multiples in the year after a halving. So I can, everyone's kind of noticed the outflows from gold ETFs this year, concurrent with the inflows into Bitcoin, and gold miners just perennially underperform the gold price because they operate in these dangerous and poor jurisdictions that are prone to nationalization, and even as all of this gold in developed markets just stays unmined in the ground because of environmental concerns. So I think that's a vicious cycle for listed gold equities personally, and Bitcoin is much more resilient to that nation state meddling because it has these simple inputs, ASICs, electricity. It can be mined anywhere. So I do see the marginal dollar going towards Bitcoin miners, but they mismanaged their balance sheets so horribly last cycle. The executive compensation was very poor. I think this cycle, hopefully we see some better management, better capital structures.
That's a great story, the whole mining aspect and the ESG. And so, I think we're well beyond that. But I know a main topic today that a lot of people wanted to hear about was the halving. And so, for those that don't know, right, Bitcoin's monetary policy was set from day one. And every 4 years, we get this halving event where the supply of Bitcoin gets cut in half. And so right now we're mining, 900 Bitcoin per day. And then around April 20th, that'll go to 450 Bitcoin per day. And so just your overall comments, Matthew, on what you see coming as far as, the halving event. What are your expectations as we kind of ramp up to that?
Yeah, I think from the big picture perspective, we believe in the 4-year cycle, and the data shows that the majority of the cycle's gains tend to come after the halving. So we had been expecting an all-time high in Q4 of this year as the US election would resolve, and that typically prompts a rally in risk assets, and it also generally bakes in the cake 4 more years of unsustainable budget deficits. That cycle looks to be pulled forward a little bit because of the ETF demand. in the last few days, we did a deep dive into what exactly happens in the run up to and then immediately after the halving. And this is like 3 weeks before, 3 weeks after. We couldn't find any price pattern that stood out to us as something likely to repeat. There, the sample size is not too huge. So then I go back to that base case. Well, if the bulk of the returns happen in the halving year, then you want to be pretty much fully invested going into it. What we did notice is that the hash rate does tend to fall by between 10 to 20% in the kind of couple weeks up to and into the halving. And then within 3 weeks, it rebounds to an all-time high as the low-cost miners are able to pick up market share from anyone who may have dropped off the network. So the other thing I'd say is that last cycle, we came into the Bitcoin halving at a 62% Bitcoin dominance, which means that Bitcoin market cap divided by total crypto market cap was 62%, and then a year later it was 52%. So I wouldn't be surprised to see this Bitcoin dominance kind of extend a little bit into the halving, but then assuming that everything goes on track, that's when folks may recycle some of those profits into more speculative altcoins.
Yeah, it's funny. I think that Bitcoin dominance thing is kind of a bad scale just because it's denominated in fiat versus hash rate. Like if we were to take the Bitcoin dominance in terms of hash rate, I think we'd see that figure way, way higher than it is currently. So, we're also entering a very interesting time to where we may actually see an all-time high before the halving, which has never happened before, and so any thoughts on if we're going to see that, or you think we're going to get a slight dump right before the halving? Where's your price predictions for that event?
I don't have I'll go back. I'll repeat the statistic that whenever we hit 90% of the network in profit, we tend to hit 100% in short order. So, I think there's a good chance for an all-time high. And then I can just kind of tell you how I'm positioned managing a strategy of large cap coins. If you look back on like Twitter threads in late December, I put out a thread that kind of ETH's underperformance was overdone, and here are the kind of 6 to 8 catalysts on why it may reverse. That has played out pretty well. In general, large caps have outperformed this year, and that's kind of what my roadmap was for the pre-halving. I thought that prices might be a little squishier kind of leading up to the halving. That would favor large caps, and then if we got great flows, which we have gotten, then people would have to buy BTC and ETH, and that's happened. So it's been a very good start to the year. Have taken a little bit of that kind of large cap risk down a little bit to dabble in some of the other underperforming larger cap tokens, but still have a bias that TradFi and no coiners are going to buy what's easiest, and that's BTC and ETH. So taking some off, but still letting the overweight run, so to speak.
Okay, great. And so since we're talking about ETH, we're starting to bring up some of the other coins. I believe VanEck has filed for a ETH ETF as well. Is that correct? And so
yes.
What is your thoughts on if that's going to get approved, and proof of work versus proof of stake type of systems? Is there any kind of, I guess, mental conscious battle with that? Being a Bitcoiner, how does that look in your eyes?
Yeah, we do have a filing which is live with the SEC, and they have until May 23rd to deny it or approve it. Given there's been a lack of sound logic heretofore by this regulator who had to be sued like a deadbeat dad before approving the Bitcoin ETF. Just very hard to predict which way it's going to go. We'll be ready for it if it's approved. We don't think that staking is going to be a part of any such product, even if it is approved. And I think a lot of the market is focused on this Coinbase versus or rather the SEC versus Coinbase suit, which doesn't directly impact whether ETH is a security, but it does for a whole number of other coins. And if that suit is dismissed or partially dismissed, maybe the odds for the ETH ETF or like CME listing Solana futures or some of these like hopefully further out developments can get accelerated into this year.
Yeah, it's an interesting thing, right? Because ETH being a proof of stake system, right? The stakeholders would be the only ones who could generate new coins. So technically validators, right, would be part of that ecosystem. And so it's definitely a difference from the proof of work system. And so people really need to understand the difference, I think, between those two. People getting into crypto, right? I mean, every road eventually kind of leads to Bitcoin is what I kind of tell people. And so, we're here to help the adoption of it, no matter which way it goes.
Regarding Ethereum, I think that Matthew said, the price of Ethereum has underperformed Bitcoin, right? But maybe it's at that level when it becomes, too undervalued. Do you see it like that right now? I mean, I've been doing some of the research and comparing some metrics between Ethereum and Bitcoin and to the relative price, and they all like signal, or maybe we are in that phase where it is too low compared to Bitcoin. Are you guys seeing the same, or how do you approach it, like this analysis of the relative price of the two coins?
Yeah, I felt that with strong conviction in late December when we were kind of testing 2-year lows on the ETH BTC ratio. And given the number of catalysts for ETH, including the hard fork, which is now in less than 3 weeks, ETH is going to have a hard fork that should really catalyze some additional L2 demand. I feel that a little bit less strongly given the rally and the outperformance of kind of ETH BTC versus the rest of the field. So like, as I mentioned, kind of brought some of that risk down even more this morning. But over the medium term, ETH tends to outperform BTC in a halving year, right? So I don't want to lose the forest for the trees. I don't think there'll be a flippening, but I do think when the year is said and done, ETH will have outperformed BTC.
Okay. Yep. Yeah, I'm seeing also. I mean, I don't know the outperformance, but it's too low. I would say like it's too low for compared to Bitcoin, right? It's too undervalued, I would say, given some metrics, network metrics, or some of the traders, how is it being traded, open interest, and all that. So, yeah, that just wanted to know your.
I think part of the reason there were legitimate concerns around ETH's scaling roadmap at the end of last year, and then December was also the first month where NFT issuance on Bitcoin exceeded NFT issuance on Ethereum. So I'm talking about these ordinals on Bitcoin. And then because of Ethereum's scaling roadmap, some of its functionality is being co-opted by other projects that focus on kind of the data availability part of the stack. So I keep an eye on this index of layer ones that our index subsidiary Market Vector developed, and one of our private strategies is kind of managed with an aim to beat that index, which when it was developed did not include Bitcoin. It was L1s that were smart contract platforms. Early last year, when ordinals started to be a thing, I made an active decision to add Bitcoin to that strategy, seeing that it is kind of becoming a little bit more of an L1. So I think that's still an open debate for the market.
Outside of Bitcoin and ETH, what other ecosystems, other coins are you guys looking at?
Yeah, we've been quite vocal bulls on the Solana ecosystem. Personally, when I worked in equities, I was a big investor in Qualcomm, and that's where the founder of Solana comes from. So using some of this radio frequency technology to innovate and create a blockchain based on a theory of abundance, where if transactions are a fraction of the penny, it opens up a whole range of interesting applications that will find it a tougher time on Ethereum. So we have been, we put out a pretty comprehensive research piece with a $300 price target for Solana, and also have been public with some of our investments in adjacent physical infrastructure projects built on Solana, such as Helium and HiveMapper. Say the bulk, we kind of think about position sizing as core positions in a book, which could be 10% plus. We would typically limit that to Bitcoin, ETH, Solana, maybe like Coinbase equity. Then we have fringe positions, 3 to 5% type positions where the product has shown product market fit. It's maybe generating some fees. We can see a path towards category domination and an acceleration in those fees. So there may be some alt L1s in that kind of fringe, or L2s even in that fringe category. And then we've got moonshots like a Helium or a HiveMapper, where it's very early stage, liquid venture. Maybe the product has not yet shown product market fit, but we hope we've caught an inflection, and those would typically be like 1% positions.
Awesome.
Matthew, just talking about the fringe investments. I saw that you published something related to AI. What are your thoughts on that sector?
Yeah, we think that there's a logical connection between AI and crypto, and that connection has been, I think, validated with Google's most recent AI release. So a lot of people probably saw they put out this new Google Gemini that is meant to generate images, and it was literally incapable of generating like images of white people even when asked on demand. I actually asked it to generate an image of crypto programmers in a sparse office being bros, and it told me that I was furthering the stereotype of harmful programmers, and it was not going to succeed. So we think that these closed source models are often not credible, and they don't react quick enough to client feedback. And in our estimates for kind of crypto AI software, we assumed that open source models would gain 5% market share. That's a pretty small penetration rate, and we still got to $10 billion in crypto AI revenues by 2030. Now those 5% penetration rates maybe seem a little bit low, but crypto provides important foundational elements that AI needs to be successful: transparency, immutability, clearly defined ownership properties, an adversarial testing environment that allows for fast iteration. So these properties are going to allow AI to reach its full potential. And we've invested both at the venture level and somewhat in liquid tokens as well on this theme. Although when you look at, we're big on identifying a category we think is going to grow, a project that can have a dominant market share, and with a token where the value accrues back to the token holder. And many of these AI projects are not yet really doing this, the third. They're more hopium. There's some good hopium, but it's hopium, and so position sizing there is important, right? We're more likely to be at that 1 to 2% weight than something much larger. Render is a good example of one that we have highlighted and owned in the past. Network of decentralized GPUs that helps with video and image rendering. It does look like Apple is going to have an open source image generating model in the next version of iOS 18 or on the iPhone 16, and Render is going to play an important role in that. There's now companies that use the Render network and offer service level agreements to their end client. So this is a B2B network. I think that is underappreciated by some of the market.
You say that one of the things that you look is like the fees, return some of the fees to the holders, right, of the token.
Holders or stakers or
stakers. That's important because I don't know if you saw like this is how other sectors, decentralized exchange, but Uniswap. They propose like, okay, so part of the fees go to the holders, and that increased a lot the value of this token, right? Because some of the gains are coming back, right, to the holders or stakers. It's really important, right, for a token, I guess, to return some of the value to the holders.
Exactly. Our index subsidiary Market Vectors recently released a new index that they're calling the Fundamental Token Index, which weights the constituents based on the fees that users are paying to use the blockchain. That index has outperformed quite a bit since it was launched at the end of last year, and it had what I would call a counter consensus 10% weighting to Uniswap, because Uniswap shows up, it screens very well on fee generation, but those fees, until this recent proposal, or even if this recent proposal isn't approved, those fees don't actually go to the token holder itself. I think the price action of Uni kind of showed us that it's about the future. It's what is the plan. You can't not own a token that has dominant market position and is generating fees just because the switch hasn't been turned on yet. And you may wake up and the judges dismiss this SEC suit versus Coinbase, and suddenly none of these tokens are securities and they're all up a ton, even though they haven't turned their fee switch on. So it's been helpful to have our subsidiary producing all these indices that me as a PM, I got to look at whatever is hurting my performance in the face every day and test our assumptions.
Okay, so let's talk about this new segment launch you guys did today, which is an NFT, I believe, marketplace. Do you want to give us a little bit more insight? Is this second layer? Is it like Stacks environment? Is it ordinals? What are you guys looking at? Everything? Kind of what is the strategy here for you guys in this space?
So it's on Ethereum for now, and what the technology does is enable anyone to lock an NFT in a vault and then generate keys that can be distributed to folks who want to own a portion of that NFT. And then all the keys are required to unlock the original NFT itself. So you come to Segment, you create a digital vault that is still owned by your Web3 wallet address. Once you've locked the NFT in the vault, you can create any number up to 100 of what we call these segment keys. The keys are ERC 1155 tokens. So they are semi-fungible clones of whatever the NFT that is locked inside. And they're called keys because you must own them all in order to unlock the vault to take transferable ownership of whatever that asset is. So the keys represent a form of shared access or shared ownership. And then you may have seen from the release, the core functionality is not available in the US. So yeah, I think that I hope the viewers can kind of do your own research, go to Segment and check it out for themselves.
So actually fractionalizing each NFT so they can have a partial ownership to get access to that speculative asset.
Exactly. Or, you know, it could be in the future, it may not be a speculative asset. The key may unlock some type of service, subscription to a newsletter, what have you. So many use cases for NFTs. It starts with profile pics, but we think the technology enables so much more than that.
Yeah, so that's a good kind of segue into that. So what is your thoughts on, you know, tokenized equities? Like, what do you guys see that as a future for the market?
I'm being facetious, but we've done a lot of R&D on kind of tokenized real world assets, and the opportunity cost of capital and time just doesn't seem worth it. The liquidity for the real world assets on chain is extremely fragmented. You don't really save costs by bringing these products to market. EU regulation has made it very tough to even just bring a gold token to market in Europe, given the capital requirements. They are really rewarding scale from day one over there with that regulatory regime. And then the tech is very commoditized, so you can bring something to market very quickly and easily, but then it's a distribution game. So just from an opportunity cost perspective, the money is better placed in Bitcoin, Ethereum, smart contract platforms, dApps. You know, once Bitcoin reaches our price target, I'm sure there'll be a lot more wealth in the system that is looking for kind of on-chain real world assets, but not seeing the profit motive to get aggressive in the manufacturing. We're just kind of keeping warm on the R&D. Probably will be a fast follower there.
What about some macro environment stuff? Are you guys seeing a Fed pivot? Do you guys think rates are going to be cut? What is your opinion on what's going to happen with the Fed here in the next couple of cycles?
We do think that the liquidity environment is better this year than it was last year, but we're cognizant of the supply side constraints in the energy markets, you know, causing a potential for kind of a second leg up here in inflation. So Jan, the CEO, has described, I think, this year as kind of a sideways year. And we're more taking kind of tactical mean reversion trades rather than like going all in on risk, so to speak. You know, we like equal weight and like energy strategies over big tech. And we like crypto as the fundamental hedge on big tech. One analogy I like to make for advisors who, you know, are scared of a 2% position in Bitcoin is that Meta stock, Facebook, is a 2% weighting in the S&P, and Meta fell more peak to trough in 2021-22 than Bitcoin did. It fell 80%. Bitcoin fell 77%. So for us, crypto is a hedge on someone who is overweight to FANG. These, you know, community-owned open source networks are likely to take margin and users away from big tech. So, you know, a 2% weight in that context should seem less scary.
And you know, for new investors, right, that are still scared of this environment, you guys provide an easy on-ramp with the HODL ticker, right, the Bitcoin ETF. What would you say is kind of the easiest strategy for someone that's totally new to this, right? Just DCA? Do you like buy more on the dips? Like, what is someone that's completely new to the space? What would you recommend to them?
Yeah, we recommend DCA, and even for subscribers into the private funds, we generally say, hey, space it out, over 3 to 4 months, put in a quarter, like once a month for 4 months. The volatility on the asset class is just so extreme, and you can overshoot and undershoot dramatically. You might not be in front of your screens the day when that happens. Hopefully we will be. On the active side, we've had some good success trading around, but DCA is the best.
For the Bitcoiners that will say, not your keys, not your coins. Do you guys have any risk assumptions with possibly an Executive Order 6102? I mean, you've seen very aggressive action by this administration. And obviously it's probably somewhat in the back of your mind of possibly, if something like that happens, if there's another banking crisis, right? We're about a year away or year out from the Silicon Valley collapse. What do you say to that, those types of at least allegations, or at least people concerned with that?
Yeah, I think that diversification is the name of the game, and so there are clients who want to own a portion of their coins via their own keys and self-custody, and then want to diversify across one ETF or a number of ETFs. The reality is that Americans probably have little to fear about the government explicitly banning or seizing Bitcoin. It would probably be accomplished through more backdoor means, like taxing the mining, the miners, or probably from a tax perspective. And it's really the rest of the world that for whom the self-custody is probably a more meaningful decision. And then when you think like, okay, what are the circumstances that are going to cause the rest of the world to accelerate their purchases of Bitcoin? Well, it may be the very things that you're talking about, which is some type of government overreach on any number of topics. So the ETF for US investors provides a handy way to kind of speculate on that outcome without the complexities of owning your own keys.
Yeah, it is a complex process, but yeah, it's a great answer, right? Like, maybe have your money's in the market, put it into the ETFs. You want to have some for that rainy day stash in case there is, more aggressive action by this administration. Hold some of your own keys. So like that answer.
I mean, just in general, what do you look at when deciding what to research for, for the industry? I mean, there's limited resources on what you could research, right? And so how do you approach that process?
Yeah, so I used to work on an equity fund, and the information flow is very different in TradFi. There are 20 plus institutionally geared stockbrokers who are providing research and, importantly, access to management. And then there's the quarterly cadence of earnings reports. So there's kind of a more systematic way to digest information, and that was one of the challenges, I think, for folks moving from TradFi to crypto, or just managing these crypto funds within a good regulatory framework, because we treat all these tokens like they are securities. And so if we inadvertently happen upon some material non-public information, we restrict ourselves from trading the token. We tell our compliance team. It's all very regimented. So I think that getting in the flow of that information for crypto, it's like three things can move the price of an asset, or three things are worth keeping an eye on: the price itself, what's moving, why is it moving, news, so that's watching the tape, wire services, data providers that we subscribe to, and then high quality research, someone who's written something that's just is true thought leadership. And I think watching the markets through those three elements: price, news, and research, the manager has to find the right mix within that alchemy, and that's more art than science.
Do you have
Yeah,
some
and
favorite metrics of CryptoQuant's data that you enjoy?
I think that I remember Key tweeting in December 2022 some of the, in hindsight, obvious capitulation signals. Miners, coins sent to exchanges, the realized cap of the market, the charts that Julio showed at the onset here. You know, I think you guys are doing a great job of like continually iterating, finding new wrinkles on the existing data. So please keep it up. It's useful input into our process.
Awesome. Which mass trend is next? What do you guys envision?
A couple things. One is earning yield on Bitcoin. So in the last cycle, the only way to earn yield on Bitcoin was to hand it over to some OTC player who lost it, BlockFi, Genesis, etc. That functionality should be more available in smart contract form this year. So carefully watching projects like Babylon, which is a Cosmos-based proof of stake chain that's figured out a way to essentially slash Bitcoin. So you can stake your Bitcoin on a proof of stake chain and maybe earn some Babylon coins in return. Should be a source of yield and a token sink for Bitcoin holders. Similar dynamic with Stacks, a layer 2 on Bitcoin that's hard forking around the time of the halving in a way that should compress block times quite a bit more and maybe reinvigorate the Bitcoin DeFi ecosystem. So definitely more, more excited about Bitcoin layer 2s this year, although we haven't seen like meaningful fees from any types of those projects. So I'd say those are still moonshot and fringe level positions for now.
Have you guys done any research into Counterparty, the other layer 2 that's been around since 2014?
Please send me some work on
Okay.
Counterparty. Would love to read more.
Okay.
And also the gaming environment, Web3 gaming. I think there's a lot of capex put into that market segment over the last 3 years, and I think there's a lot of frustration that there hasn't been a mega hit. But when you look at like our metaverse index or gaming index, token prices have underperformed pretty dramatically over the last couple of years, and we're starting to notice some new ideas, some compelling game releases that we've increased our weighting a little bit in that segment.
No, this has been a great conversation, and we just crossed briefly 61K, guys. So congrats to all the hodlers out there. We're excited. I think we have a lot of bright things happening in the ecosystem, and you guys at VanEck are doing an amazing job helping bring more awareness to Bitcoin and the crypto industry in general. And so we thank you guys for that. Again, guys, you guys can get the VanEck ticker symbol at HODL, right? And then also go check out CryptoQuant.com if you'd like to get set up with an account to take advantage of some of these alpha metrics. But any parting words, guys?
No, thanks for the time. Great conversation, great work, Julio, Garrett. Thanks everyone for joining.
We'll catch you guys next time at Liquid Lunch, powered by CryptoQuant. See ya.